Welcome back to WealthWise, the podcast where clarity meets strategy, helping you build a life of financial intention and freedom. I'm your host, Sarah. Today, we're diving deep into a word that often carries a heavy weight, but also immense power. Debt. Is it the key to unlocking financial growth, or a cleverly disguised trap that keeps so many people stuck? We're going to be exploring debt. Financial leverage, or a sweet deception. And to help us navigate this complex terrain, I'm absolutely thrilled to have the brilliant Max Wise with us. Max isn't just a financial strategist. He's a renowned wealth educator who spent years in the trenches helping individuals and businesses understand the true dynamics of money. He's known for cutting through the noise and delivering actionable, real-world insights. Max, it's a pleasure to have you. Now, for everyone listening, by the end of this episode, you're going to walk away with some game-changing perspectives. You'll discover 1. The often hidden strategies the wealthy use to leverage debt, not just to build their fortunes, but sometimes to do so while minimizing their tax burdens. 2. The common, almost insidious debt traps that cause most people to inadvertently enrich their bankers instead of themselves. And most importantly, 3 golden rules you can implement today to start using debt intelligently, turning it from a potential master into a powerful servant. Max, welcome to WealthWise. It's genuinely great to have you here. So let's jump right in. Debt is a concept as fundamental as money itself, yet it seems to be one of the most wildly misunderstood and, frankly, often misused tools in personal finance. In your experience, why is this topic so misunderstood?
Sarah, thanks so much for having me. It's a fantastic question, and one that gets to the heart of why so many people struggle financially despite working incredibly hard. I believe there are a few key reasons for this widespread misunderstanding. Firstly, there's this immense societal pressure and pervasive consumer culture. We're constantly bombarded with messages that equate success and happiness with material possessions: the newer car, the bigger house, the latest gadgets, the exotic vacation. And often, the easiest, most immediate way to acquire these things is through debt. It's the keeping up with the Joneses phenomenon, amplified by social media, where curated lifestyles create an illusion that everyone else is living large. This pushes people into making financial commitments without fully grasping the long-term implications. Secondly, there are some deeply ingrained and often dangerous misconceptions about how debt works. A classic one is the affordability illusion. People think, well, I can swing $400 a month for that new SUV, $60 a month for that top-tier phone. They focus on the affordability of the payment, not the total cost of the debt, including the interest that can sometimes double or triple the original price over the loan's lifetime. They're essentially renting money at a very high premium. Another common misconception revolves around things like 0% APR financing deals. On the surface, they seem like a no-brainer. Why pay cash when I can spread it out for free? But often, these deals are designed to get you to spend more than you otherwise would, or the cost of the financing is subtly baked into the price of the product. And critically, if you miss a payment or don't pay it off within the promotional period, you can get hit with incredibly high retroactive interest rates. It's a very clever marketing tactic that plays on our desire for instant gratification and the appeal of free money.
That's so true. The monthly payment trap is something I see people fall into all the time. It feels manageable in the short term, but the long-term cost is rarely calculated.
Precisely. And let me give you a stark, real-world example of how this plays out on a massive scale. Consider credit card debt. According to recent Federal Reserve data, total credit card debt in the U.S. has surpassed $1 trillion. $1 trillion! The average household with credit card debt carries a balance of, let's say, around $8,000 to $10,000. Now, with average APRs often hovering between 20 to 25%, If that household only makes the minimum payments, they could end up paying thousands, sometimes tens of thousands, just in interest over many, many years. Think about that. All those hours worked, all that effort, essentially going to service the debt rather than build actual wealth. It's like being on a financial treadmill, running hard, but not really getting anywhere. I remember a client who came to me, a young professional earning a good salary, but constantly stressed about money. We did a deep dive, and it turned out a significant portion of their income was being eaten up by payments on a luxury car loan they took out to fit in at their new firm, and multiple store credit cards they'd opened for those 15% off today deals. The interest rates were crippling. They were working to maintain a certain image, but the financial reality was a constant source of anxiety. It took a structured plan to dig them out, but it was a powerful lesson in how easily good intentions or societal pressures can lead to detrimental debt.
That's a powerful illustration, Max. It really brings home how disconnected our spending habits can become from our long-term financial well-being. And it perfectly sets the stage for what we need to unpack next. The core insights into how we can shift our mindset and our actions around debt. Because if we don't understand these mechanics, we're essentially playing a game where the rules are stacked against us.
Exactly. Understanding these pitfalls is the first step. The next is learning the strategies to make debt work for you, not against you. And that's where the truly interesting part begins.
All right, Max, we've touched on how debt is often misunderstood and misused, but you also hinted at a different side of the coin, how the wealthy or financially savvy individuals actually use debt. It's almost like they're playing a different game. You mentioned Elon Musk earlier. Could you elaborate on how people like him or others who've built significant wealth actually turn debt into a powerful tool for financial growth rather than a burden?
Absolutely, Sarah. It's a crucial distinction, and it often boils down to using debt to acquire or control assets that have the potential to grow in value or generate income, rather than liabilities that just consume cash. The Elon Musk example is a fascinating, though extreme, illustration of a broader principle. Many ultra-wealthy individuals, particularly those whose wealth is tied up in stock envy, don't necessarily live off a massive salary. A high salary, as we know, means a high income tax bill. So what someone like Musk might do, and this is a strategy employed by many, is to be compensated significantly in stock options. These options give him the right to buy Tesla shares at a predetermined, often much lower price than the current market value. So imagine Tesla stock is trading at, say, $200 a share, but his options allow him to buy it at $20 a share. As the company succeeds and the stock price climbs, the value of his unexercised options or the stock he acquires balloons. He might be sitting on billions of dollars in paper wealth. Now, here's the clever part regarding debt. Instead of selling a large chunk of that stock to generate cash for living expenses or other investments, an action that would trigger capital gains taxes, he can go to a bank and say, "Look, I have X billion dollars in these highly valuable liquid assets, the Tesla stock. I'd like to take out a loan, let's say a few $100 million, using my stock as collateral." Banks are generally very willing to lend against such high-quality collateral at favorable interest rates. The key here is that this loan isn't taxed as income because, well, it's debt. He gets access to cash, lives off it, perhaps reinvests it, all while his original asset, the stock, hopefully continues to appreciate. If Tesla's stock value continues to rise, his net worth increases, and he can potentially borrow more against it in the future, perhaps even to pay off the interest on the initial loan. It's a way to access liquidity and maintain a lifestyle without incurring immediate, massive tax events. Of course, Sarah, this strategy isn't without significant risk. If the value of the collateral, the stock, plummets,
He could face a margin call, forcing him to sell assets at a bad time or provide more collateral. But the underlying principle is key: using appreciating assets to secure debt for strategic purposes rather than taking on debt for consumption. It's not just billionaires. Sophisticated real estate investors do this all the time. They'll buy a property, perhaps improve it or wait for market appreciation, and then refinance to pull out equity, cash. That cash, which is loan proceeds and thus not immediately taxable, can then be used to acquire another income-producing property. They're using debt to expand their asset base, and the income from those assets helps service the debt.
That's a profound shift in perspective. It's not about avoiding debt altogether, but about what the debt is for and what stands behind it. So it's less about the debt itself and more about the strategic deployment of it against assets.
Precisely. It's about making debt work for you, and that often means having it tied to something that's working even harder. The wealthy don't just use their own money to build wealth. They often use strategically acquired debt backed by appreciating assets to amplify their financial power.
Okay, so that's the good debt playbook, using it to acquire assets that grow or generate income. But as we discussed earlier, most people aren't playing that game. They're often caught in what we might call bad debt. What are the most common ways people fall into these debt traps, effectively making their bankers richer instead of themselves?
That's the unfortunate reality for many, Sarah. The most common pitfall by far is using debt to finance depreciating assets or pure consumption. Think about it. A brand new car loses a significant chunk of its value the moment you drive it off the lot. If you've taken out a 5 or 7-year loan to buy it, you're paying interest on an asset that's continuously worth less. That's a direct wealth drain. The same goes for financing furniture, electronics, or lavish vacations that provide temporary enjoyment but no lasting financial value. You're paying a premium, the interest, to consume something today, often at the expense of your future self. Then, as we touched upon, there's the alluring trap of high-interest credit cards. These are so insidious because they offer convenience and instant gratification. That $8,000 average household credit card debt I mentioned at a 25% APR, if you only make minimum payments, you could be paying for that dinner or those clothes for a decade or more, with the interest paid far exceeding the original cost. It's a classic example of making your bank very wealthy. The marketing is brilliant, rewards points, cash back, but for those who carry a balance, the interest charges dwarf any rewards. And let's revisit those 0% APR deals for a moment, because they are incredibly effective for retailers. You asked why companies offer them if they're not making money on interest. Well, they often are, just in different ways. One, lowering the purchase barrier. It's psychologically easier to commit to $50 a month for 24 months than $1,200 up front. They sell more units. Two, increased upselling. When you're not feeling the immediate pain of the full purchase price, you're more susceptible to buying extended warranties, accessories, or more premium versions. What's another $10 a month for the better model? And three, the late payment or default jackpot. A significant number of people, for various reasons, fail to pay off the balance within the 0% promotional period. When that happens, the deferred interest, often at a very high rate, sometimes 20 to 30%, can be retroactively applied to the entire original balance. Suddenly, that free loan becomes incredibly expensive. The companies count on a certain percentage of people falling into this trap. So, essentially, bad debt is any debt taken on for things that don't grow in value or generate income, especially when that debt comes with high interest rates. It's borrowing from your future to fund your present lifestyle, and the cost of that borrowing can be exorbitant.
It's like a slow leak in your financial boat. You might not notice it day to day, but over time, you're taking on water and wondering why you're not making progress despite bailing as hard as you can.
It explains so much about why people feel stuck, even if they have a decent income.
Exactly. They're working hard, but a significant portion of their effort is just going to service the cost of past consumption. If your debt isn't actively working to build your assets or income, it's silently working to dismantle your financial future.
This is all incredibly enlightening, Max. So, we understand the good debt strategy and the bad debt pitfalls. For our listeners who are now perhaps looking at their own debt situation with new eyes, what are some concrete, actionable rules they can start implementing today to manage debt more wisely and maybe even start using it strategically?
Absolutely. It's about shifting from being a victim of debt to being a master of it. I generally advise people to internalize 3 core rules. Rule number 1. Drastically limit or eliminate financing for liabilities, with the primary exception often being your primary residence. This means no more car loans for depreciating vehicles if you can avoid it. No more financing furniture or electronics on store cards. And yes, this includes those tempting 0% APR deals for consumer goods. The goal should be to pay cash for these items. Now, I can hear people saying, Max, how am I supposed to buy a $40,000 car with cash? And my answer is, maybe you don't buy a $40,000 car right now. Maybe you buy a reliable $10,000 car with cash. Take the $700, $800 a month you would have spent on the car payment for the fancier car and aggressively save it, invest it, or use it to pay down any existing high-interest debt. I personally drove a very modest, paid-off car for years, even when my income could have supported something much flashier. Why? Because every dollar not going to a car payment was a dollar I could put to work building assets. It's about prioritizing long-term wealth over short-term appearances.
That's a tough pill for some to swallow, especially in a culture that often equates your car with your success. But it makes perfect financial sense. What's rule number 2?
Rule number 2 is what I call the rule of 5 for discretionary luxury purchases. This isn't for necessities, but for those want-to-have items, the expensive watch, the designer handbag, the top-of-the-line golf clubs. The rule is simple. If you can't comfortably afford to buy 5 of them with cash, you can't truly afford one. So if you're eyeing a $10,000 Rolex, you should ideally have at least $50,000 in liquid savings or investments after accounting for your emergency fund and other financial goals before you even consider buying it. If you want that $50,000 BMW and you're determined not to follow rule number 1 for some reason, you should have a net worth or liquid assets that make that purchase feel insignificant, say $250,000 or more. This rule isn't about deprivation. It's about ensuring that your luxuries are a reflection of genuine financial abundance, not a contributor to financial stress. It forces you to contextualize the purchase against your overall financial picture.
The rule of 5. I like that. It's a very clear benchmark. And the third rule?
Rule number 3 is what I call to when you do use debt for building a business or investing in real estate, use it strategically to scale what you've already proven, not to start something from absolute scratch on a prayer. Too many aspiring entrepreneurs or investors think they need a big loan to get going, but often needing debt to simply begin a venture means you haven't validated your concept or built a solid foundation. Debt in this scenario just amplifies your risk and your potential mistakes. I had a bank manager once tell me about a client who wanted a $70,000 loan to buy a pet grooming business. The problem? The business was losing money every month. The current owners weren't even paying themselves a salary. And there was no non-compete clause, meaning the seller could open an identical shop across the street the next day. The client could have started the same business from scratch for a fraction of that amount, with less risk. The smart way to use debt in business or real estate is when you have a proven model. You know your product sells, you understand your market, you have cash flow. And now you need capital to expand, to buy more inventory, to open a new location, or to acquire another rental property that fits your success criteria. In this case, debt is fuel for an already burning fire. For real estate, for instance, while no money down deals sound amazing, they are incredibly risky,
especially for beginners. I'm a much bigger advocate for having a solid down payment, 20 to 25% or even more. This gives you equity, a buffer against market fluctuations, better loan terms, and more peace of mind. You're less likely to lose everything if things go sideways, which they sometimes do, especially when you're learning.
Those are incredibly practical and robust rules, Max. Stop financing liabilities, the rule of 5 for luxuries, and use debt to scale proven ventures. It really shifts the mindset from passive debt accumulation to active, strategic debt management.
Exactly. It's about being intentional. Debt isn't inherently good or bad. It's a tool. And like any powerful tool, its impact depends entirely on how you wield it. Don't use debt to dig a financial hole. Use it as a strategic ladder to climb towards your wealth-building goals. One proven step at a time.
Max, we've discussed these powerful rules and the broader concepts of good and bad debt, but often the most profound lessons come from personal experience, especially from those moments that don't go as planned. In your own financial journey, was there a particular turning point, perhaps a mistake or a challenging situation involving debt, that fundamentally changed how you think about it and how you advise others today?
Oh, absolutely, Sarah. There's one experience that stands out vividly, even now, many years later. It was early in my career. I had had some initial successes, and like many young people who start to see a bit of money come in, a certain, let's call it overconfidence, began to creep in. I thought I had the Midas touch to some extent. At the time, there was a lot of buzz around no money down real estate investing, highly leveraged deals that promised incredible returns with minimal upfront capital. It sounded like the fast track to serious wealth, almost like printing money. And I got suckered in by an opportunity that, on paper, looked like a grand slam. It was a small, multi-unit residential property, and the deal was structured so I could acquire it with very little of my own cash, primarily using borrowed funds, a big mortgage, and a secondary loan. I was told the rental income would easily cover the debt service and operating expenses, leaving a tidy profit. I was already picturing myself as a real estate mogul in the making. I chuckle softly at the memory. Well, the reality was a brutal teacher. Shortly after I closed on the property, a couple of things happened almost simultaneously. The local economy took an unexpected dip, and one of the major employers in the area announced layoffs. Suddenly, finding and retaining good tenants at the projected rental rates became a massive challenge. Then, the property itself started to reveal its age, a significant plumbing issue that wasn't caught in the inspection, followed by a roofing problem. These weren't minor repairs, they were substantial, unbudgeted expenses. Suddenly, instead of positive cash flow, I was bleeding money every month just to cover the mortgages, the taxes, the insurance, and now these urgent repairs. The no money down dream quickly turned into a negative cash flow every single month nightmare. I was pouring my own savings into this property just to keep it afloat, to avoid defaulting on the loans. The stress was immense, Sarah. Sleepless nights were common. I remember staring at the ceiling, doing mental gymnastics, trying to figure out how to get out of this hole. There was the financial strain, of course, but also a huge blow to my ego. I, the guy who was supposed to be smart about money, had made a classic rookie mistake, driven by greed and a lack of thorough due diligence. I had focused on the potential upside and almost completely ignored the downside risk of being so heavily leveraged. I had focused on the potential upside and almost completely ignored the downside risk of being so heavily leveraged. Eventually, after about 18 months of struggle, I managed to sell the property. I took a significant loss, not just the money I had put in for repairs and to cover the shortfalls, but also the hit to my credit from juggling things. It was a painful, humbling experience. But the lesson it burned into me was invaluable. It taught me, in a way no book or seminar ever could, the raw power and immense danger of leverage. Leverage amplifies everything. It can amplify your gains, but it will just as readily and often more aggressively
amplify your mistakes and your losses. It taught me the critical importance of having a substantial safety net, of doing exhaustive due diligence, and of never, ever letting the allure of quick profits cloud sound judgment, especially when debt is involved. It made me realize that building true, sustainable wealth is a marathon, not a sprint, and that boring, well-capitalized investments are often far superior to exciting, highly leveraged gambles. From that day forward, my approach to debt, both personally and in my advisory work, became far more conservative, far more strategic, and always, always risk-aware. That failure was, in a strange way, one of the best financial educations I ever received.
Wow, Max, thank you for sharing that so openly. It's a powerful story, and I think so many people can relate to that feeling of being caught in something that feels overwhelming. That lesson about leverage amplifying mistakes is incredibly potent. It really underscores the need for the kind of caution and strategy you've been outlining.
Indeed, sometimes the best lessons are the most expensive ones, unfortunately.
Max, shifting our gaze forward now, we've talked about the principles of debt, the pitfalls, the strategies. Looking at the next 3 to 5 years, if you had to bet on one significant shift or trend related to how individuals perceive or use debt, or a development in the financial landscape that will define success in managing it, what would that be?
That's a great question, Sarah, because the landscape is definitely evolving. If I were to pinpoint one overarching trend, I'd say it's the accelerated rise of tech-enabled financial literacy and personalized debt management, driven significantly by artificial intelligence. For too long, many individuals have navigated the complexities of debt somewhat in the dark, often relying on generalized advice or, worse, the marketing messages of lenders. We see so many people still unclear about the true cost of their loans, the impact of different repayment strategies, or how their debt profile affects their overall financial health. In the next 3 to 5 years, I foresee a proliferation of sophisticated yet user-friendly AI-powered tools and platforms that will democratize access to high-level financial insights, specifically around debt. Imagine hyper-personalized debt optimization, AI algorithms that analyze an individual's complete debt portfolio, mortgages, student loans, credit cards, auto loans, and provide truly tailored, dynamic strategies for the most efficient payoff, considering interest rates, loan terms, tax implications, and even the individual's cash flow and risk tolerance. It won't just be pay the highest interest first, it'll be far more nuanced. Proactive opportunity alerts, tools that constantly scan the market and alert you when, for instance, a significant drop in interest rates makes refinancing your mortgage highly beneficial, or when a balance transfer offer genuinely makes sense for your specific credit card debt, even calculating the break-even point, considering transfer fees. Predictive financial health modeling. Before you even take on new debt, AI could help you model its long-term impact on your net worth, your ability to save for other goals like retirement, and your overall financial stress levels. It's about making informed decisions before the commitment, not just dealing with the aftermath. Enhanced consumer protection. AI could also play a role in identifying potentially predatory lending practices or overly complex loan products, flagging them for consumers or even regulators. Alongside these tools, I believe there will be a continued push for more engaging and behaviorally informed financial education. It won't just be about what to do, but understanding why we make certain financial decisions, especially around borrowing, and how to build healthier habits. The focus will shift even more towards building a strong, healthy debt CV or credit profile, not just to access cheaper credit, but as a foundational element of overall financial resilience and opportunity. So, financial success in the coming years will increasingly depend on one's ability to leverage these technological advancements and educational resources to distinguish clearly between strategic, wealth-building debt
and detrimental consumptive debt. It's about empowering individuals to move from being passive debt holders to active, informed financial architects of their own lives.
That's a really exciting and optimistic outlook, Max. The idea of AI becoming a personal financial co-pilot, especially for something as complex as debt, could be a game changer for so many. It points towards a future where individuals are far more empowered.
Precisely. The tools are becoming more powerful. The key will be fostering the wisdom to use them effectively.
And just like that, another incredibly insightful episode of WealthWise draws to a close. Max, the depth and clarity you've brought to this often confusing topic of debt have been phenomenal. From understanding how the wealthy strategically leverage debt to build assets, to identifying those common pitfalls that trap so many, and crucially, those 3 golden rules for smart debt management: stop financing liabilities, the rule of 5 for luxuries, and using debt to scale proven ventures. This has been a masterclass. And your personal story really brought home the human side of these financial principles, reminding us that even setbacks can be powerful catalysts for growth. Plus, that look into the future with AI potentially revolutionizing our approach to debt is genuinely thought-provoking. So, to everyone listening, if you found value in today's conversation, and I'm sure you did, here are 3 simple things you can do to help spread this wisdom and continue your own wealth-building journey. 1. Share this episode. Think of one person, a friend, a family member, a colleague, who you know could benefit from understanding debt in this new light. Send it their way. A simple share can make a big difference. 2. Subscribe to WealthWise wherever you get your podcasts. We have more conversations like this coming your way every week, designed to give you those aha moments and actionable strategies for your financial life. And 3, let us know your thoughts. What was your biggest takeaway from today's discussion with Max? Do you have a personal debt story or a strategy that's worked for you? Find us on social media. We're at WealthWise Podcast, or leave a review. We love hearing from you. A huge thank you once again to our guest, Max Wise. It's been an absolute pleasure having you.
The pleasure was all mine, Sarah. Thanks for the great conversation.
And to our incredible WealthWise community, thank you for tuning in. Remember, the journey to financial freedom isn't about avoiding challenges. It's about arming yourself with the right knowledge and strategies to navigate them successfully. As you go about your week, keep this in mind. Financial freedom isn't just a dream you hope for. It's a strategic reality you build one wise decision at a time. Until next time, stay wise and keep building.